We've had a shortened week here in the UK. It's a 4-day trading week. That hasn't stopped the volatility. Indeed, we've had quite a bit of volatility this week, driven by the government elections both in France and in Greece at the weekend. Whilst most of the major European markets were open on Monday, their initial reaction after a sharp sell-off in the morning was to recover, and with many markets such as France and Germany posting gains. But when the UK market opened on Tuesday, we saw quite a sharp sell-off as I think the situation within Europe really turned quite ugly for market confidence. The key reason for changes in governments, the electorate tending to vote against the austerity moves that are in place, and bringing in potentially governments who will change towards growth. That's certainly the case with Hollande in France, and next week we'll turn to his first meeting with Chancellor Merkel. That will be interesting just in terms of how they co-present their different strategies on how to deal with the European problems. So that's something to look forward to next week. In Greece, the situation has gone from bad to worse. The first chart today is of the Greek stock market, which, as you can see, has halved during the course of the last 12 months. It's down from a level of around 4,000 at the peak down to about 600 at the moment. So has lost about 85% of its value from the peak levels. The key in Greece, of course, is the fact that no government can be formed at the moment, and the chances are that we'll see new elections taking place. But timing is getting very tight, with key tranches of money required in July, and obviously elections to take place during the course of June to try and sort of meet the requirements for the European Pact. And as I say, if they fail to meet that, then that is going to create some increased volatility for financial markets over that time. The other issue in Europe, of course, is Spain, and whilst at the sovereign level there have been concerns that we've been expressing over the last few weeks in relation to their own bonds, attention is turning to the banking sector within Spain. The general feeling around is that Spain has not up to this stage woken up to the problems that are inherent within the Spanish banking balance sheets. But it came to the fore this week with the second chart. This is one of the leading banks in the Spanish region, particularly for retail clients, called Bankia, a company that really only came to the market at the middle of last year, the stock market. The government has part nationalised this bank this week with a 45% stake in the company in return for a $4.5 billion loan to equity conversion. This is possibly a sign of things to come. An interesting article this week from the economist Nouriel Roubini indicated that he felt around 200 to 250 billion euros was required to bring the Spanish banking system up to the required 9% Tier 1 capital. So we've seen the first 4.5 billion, but some economists warning there's another 200 to 250 billion required. Of course, this comes at a time where Spain is desperately trying to deal with its deficit, which this year is forecast to be around 6.5%. They're trying to move that towards 3% for 2013 to meet their requirements under the European rules, and this is a time where the economy is obviously slowing very sharply, as according to some of the data. So we are expected today to hear more on banking reforms within Spain. The question mark is when does the support for the banks, which is believed to be required over the next few weeks, turn into an increased sovereign problem for that country. So I think we need to just be aware of that issue. In terms of banks, the further issue that we've seen this week came from American banks. In a surprise announcement, JP Morgan confessed to a $2 billion potential loss. Indeed, it may even grow from here because the positions haven't been closed out in part of their central functions of managing surplus cash, and it was meant to be a hedge product but wasn't hedging particularly well. So they will be taking that charge in that division during the course of this year, and we saw a 5% decline in JP Morgan stock on the back of that. I'm not necessarily sure that situation will move to other banks at the moment. Indeed, if they've taken the loss, then by the nature of these derivatives, somebody will have taken the profit. But it does serve to highlight that there continues to be risks that are misunderstood even by management within JP Morgan, and that I'm afraid puts a little bit more risk premium back into some of these investment banks. Turning to the UK market, the domestic market, we're now down on the year. We've given up those early gains that were seen in the first quarter, primarily driven off the back of the LTRO support for European markets. Indeed, at one stage the FTSE was up around 7% year to date. It has now given those gains up and effectively now trades down by about 1% on the course of this year. That's a relatively good performance. Spain, for example, is down 25% year to date, but countries like US and indeed Germany are still holding on to gains of around 7% this year. So the UK is sitting obviously below those particular targets. I think we're being impacted a little bit by the mining stocks that continue to weigh quite heavily on the FTSE 100 and FTSE 250. Some slowing Chinese data has had an impact on some commodity prices, and that has resulted in stocks like Rio Tinto, for example, now trading in negative territory for the first time this year. If we look at commodity prices, take a look at oil. You can see here the price of Brent coming down from 125 at the peak there down to about 111. Same is true for some basket of other commodities, but BP, for example, their shares saw £4 again this year, having traded up to £5 in the early part of the year. Finally, just a couple of other stories that are dominating this week. Directors' pay certainly has been an issue. We're seeing more activity on directors' pay at the moment. Aviva lost its boss this week. He resigned, having got a show of no support from shareholders at the moment. The level of decline in Aviva over a course of a long period of time requires a change of management. So one to keep an eye on if we can get some new management in there with some new ideas for Aviva. And finally, just want to look at the currency situation. We have here the euro dollar. A little bit of support during February, March and April for the euro coming in, but we have seen a return to risk off and money moving back into the dollar this year. So we are starting to see a little bit of a decline in the euro. That's a chart we'll be watching quite closely for shareholder sentiment in the course of the next few weeks.